Hi guys, so let's look at some of the consequences of running a current account deficit, why this may well pose a problem for a country, but equally why it might not be of sufficient concern as well. Okay, so the first thing to bear in mind is that one of the key areas within the current account, of course, is the trade balance. It's the most significant part of the current account over net investment income. Now, as a direct result of that, if you are running a current account deficit, it is likely to therefore mean that you are running a significant trade deficit. So your trade balance is negative, and your trade balance is simply your exports minus your imports. Therefore, the value of your exports would be less than the value of your imports. Now, because the trade balance is reflected as one of the key areas within aggregate demand, this is likely to mean that aggregate demand in the economy will reduce. Okay, so if you haven't looked at that yet, just to remind those that have, you've got consumption, you've got investment, you've got government spending, and exports minus imports. So therefore, if this is the scenario, you have more money leaving your country than actually entering your country. Because you are buying more goods from abroad in the form of imports, you're receiving those goods, and of course money is leaving your borders. So therefore you are reducing the total amount of demand in your economy. That will feed through to lower domestic demand, which will lower economic growth, and therefore there may well be an increase in unemployment as a direct consequence of this, and that may then reduce consumption and investment further down the line, further slowing economic growth. So that's really why it's argued that a current account deficit can really pose a problem. Now we can highlight this diagrammatically just down here. Here you can see I've just got a long-run aggregate supply curve, Keynesian long-run aggregate supply curve, an aggregate demand curve. So if we're therefore talking about running a persistent current account deficit, we would therefore see a shift to the left of our aggregate demand, and we would see a reduced level of real GDP in the economy. Okay, so we can see that shifting back there to Y2. Meanwhile, our price level would be at P2. So the price level may well fall initially, yet economic growth would certainly fall. If economic growth is slowing and your export industry is not competitive, then it may well of course signify that your exchange rate is overvalued, and that may require a price correction which would take place via a depreciation. Now, if the country runs or operates a floating exchange rate, this may not pose such a problem for the economy. The exchange rate can just adjust. However, if you run a fixed exchange rate regime, this can pose a significant problem, because a fixed exchange rate represents a firm commitment by the policy authorities to a particular price level for your currency. So if you are running a large current account deficit and therefore a trade deficit, then what may be seen by international speculators is the need for that price to actually come down, for that price to depreciate in value. Now that can pose significant problems, as it did for many Asian economies in the Asian financial crisis in 1997, where they were running current account deficits, they were operating fixed exchange rate regimes, and they were then subjected to speculative attacks. The currency then plunged from those pegs, and it was a real crisis for those countries at such a time. Okay. Now, something else that is worth bearing in mind when we consider this depreciation, though, for all countries, is the fact then you are talking about weak pound, imports dear, exports cheap. Okay, so what does that mean? Well, we can see these imports now are going to be more expensive. So therefore, there is the prospect of increased cost push inflation taking place via any depreciation of the currency because of a current account deficit. Now this may contribute, together with this slowing economic growth, to a situation known as stagflation, where you have inflation but you have slowing economic growth or no economic growth at all. And so that really can pose a big problem for consumers whose real incomes will not be keeping up with inflation. Okay, so we've already touched on this point here really, but there's a real risk of current account crisis. However, it will depend upon how you are financing this current account deficit. So we've seen that if you run a current account deficit, then you must be running a capital account surplus. So the question then becomes, how are you financing this current account deficit? Are you financing this current account deficit by means of hot money, speculative portfolio investment into shares, equity, government bonds and so on, which can be easily resold and then that currency reconverted back to US dollars, Japanese yen and so on? Or are you financing this current account deficit via longer term capital inflows? So for instance, foreign direct investment through property purchases within a given country. Now for the UK economy, it seems that one of the key reasons why most economists weren't too worried about the extent of the current account deficit was because of the way in which it was being financed. It tended to be about longer term financial flows, so for instance FDI and property purchases. Yet for those Asian tiger economies in the late 1990s, they were using hot money flows, hot money short-term capital flows into portfolio investment. And of course, therefore, investors were able to withdraw their currency very quickly, and there was a rush for the exit. So yes, there is a risk that if you run a large current account deficit, then you could possibly be subjected to a current account crisis, and perhaps you are most vulnerable to that when A, you run a fixed exchange rate system, and B, you are financing your current account deficit through hot money. Okay, right, so let's move on. Evaluation. Some of the evaluation I've already touched on there really, because that's high level stuff we've just been covering there. Okay, so that's really tasty for any essay on current account deficits. So evaluation, does a deficit really matter? Well, it depends, of course it does. It depends how it's being financed, as we've just discussed, but further to that, it depends how you're actually using this money. So if you are getting this capital flowing into your economy and you are using that money to actually finance investment into capital goods to increase the longer term productive capacity of your economy, then of course that may actually be beneficial to run a current account deficit at that given time. So if you are investing heavily in capital goods, then that may enable you to shift your long run aggregate supply curve out to the left. So yes, initially you may experience this sort of scenario, but then you can see that we'd actually reach another point here, which would be quite close to Y1, having shifted our long run aggregate supply curve. So the real question is here, yes, does it matter? But how are you using this current account deficit? If it is just about consumer goods, that's likely to pose more of a problem. Okay, we've mentioned how is the deficit financed, okay, but it's worth noting we live in a really globalized economy where financial flows are all over the place. So therefore, is it just to be expected that if one economy runs a surplus, that another runs a deficit? So yes, to an extent it is. So what cause for concern is that? Next point, what is the government macroeconomic priority? So what is the government really trying to achieve at any given point in time? And again, that is going to depend, but that is going to give you an excellent means of actually saying, look, does this matter? Okay, and then finally, if it is due to high trend economic growth, then the current account deficit may not be a real concern for the economy. So if the growth seems to be sustainable, in line with trend, and is taking place because the fundamentals of the economy are very, very strong, and there's a lot of investment taking place, and therefore the productive capacity of the economy is improving all the time, then therefore is that really a concern? Because if people's incomes are rising, they are likely to consume more. So to what extent should we be concerned? Right, hope that's okay, guys. Thanks a lot.